Take a deep breath and look at your retirement account balance on your phone screen right now. That number you see, staring back at you in bright green or flashing red, is a complete lie. Wall Street spends billions of dollars every year to make sure you stay glued to that screen, believing that those flickering digits represent your true wealth. But for anyone over the age of 55 who is looking for real security, that number is nothing more than a dangerous illusion. Today, I am going to pull back the curtain and show you why the market price is the least important piece of information for your financial future. We are going to explore the hidden machinery of the stock market that the big banks do not want you to understand. By the end of this video, you will no longer be a victim of market volatility, and you will finally have the tools to know exactly what your investments are truly worth. Let us start with a simple truth that most people ignore. When you see a stock price change on your mobile application, you are not seeing the value of a company. What you are actually seeing is the result of a chaotic, emotional shouting match between buyers and sellers. In the world of finance, we call this the order book. Think of it like a crowded, noisy auction house where everyone is shouting at the same time. On one side, you have people who are desperate to buy, and on the other, you have people who are terrified and trying to sell. The current price you see is simply the very last price that two people happened to agree on just 1 second ago. It does not take into account the quality of the company's products, the strength of its management, or the cash it actually has in the bank. If a large hedge fund decides to sell 1 million shares because they need to cover a loss somewhere else, the price will crash. Does that mean the company is suddenly worth less? Absolutely not. It just means someone was in a hurry to leave the room. If you are relying on these temporary emotional fluctuations to fund your retirement, you are essentially building your house on shifting sand. The real secret to a peaceful retirement is moving your focus away from the market price and towards something called intrinsic value. Intrinsic value is the absolute foundation of a stock's worth. It is what the company would be worth if the stock market closed down for the next 10 years and never opened again. To understand this, let us use an analogy that makes sense for real life. Imagine you are looking to buy a small dairy farm in the countryside. When you decide how much to pay for that farm, do you care what the guy down the street shouts out as a price every 5 minutes? No, of course not. You care about how many gallons of milk those cows produce every morning. You care about the quality of the soil and the condition of the barn. You care about the actual cash that farm puts into your pocket at the end of every month. That is the intrinsic value of the farm. In the stock market, your shares are just a small piece of a business, and that business is your farm. The most powerful way to calculate this is a method called discounted cash flow. I know that sounds like academic jargon, but the concept is very simple. It is a way of asking how much all the money this company will earn in the future is worth to you today. Because money in the future is worth less than money in your hand right now due to inflation, we have to adjust the numbers. If a company is going to pay you dividends for the next 20 years, we calculate the total value of those payments and bring them back to today's dollars. This is the only number that matters for your retirement security. If the intrinsic value of a stock is $100, but the emotional market is shouting that it is only worth $80, you have found a bargain. But if the market is hyped up and screaming that it is worth $200, you are walking into a trap. The tragedy for most American retirees is that they are currently holding portfolios full of lies. Take a look at the massive tech companies that dominate the news today. Many of these stocks trade at prices that are 50 or even 100 times their actual earnings. Investors are buying them because they hope the price will go even higher tomorrow. That is not investing. That is gambling on the hope that a greater fool will come along and pay more than you did. For a young person in their 20s, they might be able to afford that risk. But for you, as you approach your 60s, you do not have the time to wait for a bubble to burst and recover. Compare those hyped-up stocks to a boring, stable company like Coca-Cola or a utility provider. These companies might not make headlines, but they have a history of generating massive amounts of real cash. They have physical assets, factories, and brands that people use every single day. Their intrinsic value is easy to see because they send you a check in the form of dividends every quarter. As Warren Buffett often says, you should look at your stocks the same way you look at a farm or an apartment building. You do not need a daily quote from the neighbors to know if your farm is doing well. The milk in the pail tells you everything you need to know. Now, let us talk about the biggest danger facing retirees in the United States today. According to the Federal Reserve, a huge portion of household wealth is currently tied up in home equity. Many people feel like millionaires because their house in California or Florida has tripled in value. But here is the cold, hard truth. You cannot pay for your groceries with the drywall in your guest bedroom. You cannot pay for a sudden medical bill with the shingles on your roof. Home equity is paper wealth until you sell the house or take on a debt. Liquid investments that generate cash flow are the only thing that will keep you independent in your later years. This is why understanding value is so critical. If you are invested in companies that are overvalued, your wealth can vanish in a single market crash. But if you own companies that are undervalued or trading at their fair intrinsic value, you have a margin of safety. A margin of safety is like building a bridge that is designed to hold 30,000 pounds, but you only drive a 10,000-pound truck across it. Even if the wind blows or the structure cracks, the bridge will not fall. In your portfolio, a margin of safety means buying a business for 60 cents when you know it is worth $1. When you have that gap, the daily noise of the stock market stops being scary. In fact, market crashes become your best friend. When everyone else is panicking because the numbers on their screen turned red, you will be calm. You will know that the dairy farm you own is still producing the same amount of milk. The lower the price goes, the more of that farm you can buy for your money. So, how do you take back control of your financial destiny starting today? First, stop checking your account balance every day. It is nothing but a distraction that triggers your fight or flight response. Second, start looking at the cash flow of the companies you own. Are they paying dividends? Are those dividends growing every year? If the answer is yes, then the market price is irrelevant. Third, ignore the experts on television who are shouting about the next big thing. They are paid to create excitement and movement because movement creates fees for Wall Street. Your goal is not excitement. Your goal is a boring, predictable, and abundant retirement. The stock market is a tool for transferring wealth from the impatient to the patient. It is a tool for transferring money from those who follow the price to those who understand value. You have worked too hard for too many decades to let a group of algorithms and emotional traders dictate your happiness. Start looking past the lie of the market price. Seek out the truth of intrinsic value. Give yourself the margin of safety you deserve so you can sleep soundly at night. Your retirement is not a number on a screen. It is the freedom to live your life on your own terms, backed by assets that are real, solid, and true. Thank you for watching this deep dive into the reality of the markets. If you found this perspective helpful, please subscribe to the channel. We are building a community of investors who value truth over hype and security over speculation. I would love to hear your thoughts in the comments section below. Are there stocks in your portfolio right now that you suspect are lies? Let us start a conversation about what truly matters for our financial future. I will see you in the very next video.